Hey everybody, welcome to another episode of the Online Business Podcast. I am delighted to be joined today with someone I've been following for a very long time and a topic that I personally geek out on, which is finances, investing, money. I am joined today with Paul Merriman. A lot of you will know him as AskPaul online. Paul, instead of me giving the description of who you are, what you're doing, where you came from, because you're all over the place. My TikTok has always got your feeds and your videos, my Instagram. But for those who don't know about you or don't follow you, they will obviously off the back of this podcast. Talk to us a little bit about your background, who you are, and what it is you do and specialize in.
Yes, okay, cheers, Brian. My name is Paul Merriman. I'm what's called a certified financial planner. We help people with financial planning as the basics of what my career started as. We've grown a fairly successful business primarily through social media campaigns. We sold the business last year and I've been involved in a number of different businesses. I was a certified financial planner / entrepreneur. Love financial planning. I like probably what you do with your business as well, and how passionate you are about the fitness industry. I think we have that in the personal finance industry here at AskPaul. Left school, didn't do a really good leaving cert, didn't go to college. Well, went for a week and dropped out, couldn't get by rag week. Found that a struggle.
Yeah, better men than us have fallen at rag week, Paul.
And I started a job in Royalston Lines General Insurance at 18, giving motor and home quotes over the phone. There was no internets or big websites back then, and it's only 20 years ago. Not that old, by the way, but still, it wasn't as prevalent as it is today. And then moved into Irish Life. I started a QFA, Qualified Financial Advisor exam, working my way up through there, and then about 10-12 years ago set up to a company called Pax Asset Management. Myself, a guy worked for me, Connor, and that was it. We shared office in Bagot Street. Hadn't got a pot to piss in. It was really tough, and we just started with small client banking, grew it, and then somebody put me on to Gary Vaynerchuk about 2016, 15, looked a bit of his content. I said, I'll give this AskPaul thing and see, can we genuinely try and... I never thought it would turn into what it did. I honestly didn't. I thought we'd just give free content and we might get a couple of clients that might ring and trust us enough if they like us. And we started on Snapchat back in the day, was pretty big, and Facebook. And I was a massive follower of yours, not going to lie. I'm kind of getting a bit starstruck even talking to you. I've read your book, I've watched your listened to your pods, used to binge all your content back to when you used to do your content sitting in your car after the gym giving tips. So you look at people around you, what they're doing, and try implement it. And in fairness, had a big video I went to Madrid to few pals, and I went to a bank in Madrid seeing what interest rates they were charging first time buyers compared to what we were charging in Ireland. Did a video on Snapchat and Facebook. It blew up. Virgin Media rang. I was on the couch on the Sunday. Then I did that every couple of weeks. Radio stations rang. Hired a marketing team. And we sold the business last year with 68 employees. I say we do.
I know you can't say the price, but it was reported at over 20 million. I know you can't kind of get into it, but just for people to give a little bit of context.
Yeah, it was a big deal. It was a big sale, so we're delighted. And the company are a phenomenal company, Fairstone, that acquires from the UK. CEO over there, Lee Hartley, it's like sitting down with a lecturer on a PhD course every time you sit in the room with these guys. So you're just trying to level up all the time. But we're trying to acquire now in the Irish market. We've just done our first acquisition. So Fairstone have acquired us to try and help grow the Irish market by acquisitions. So we're hoping to do 30 to 40 acquisitions over the next 5 years, and we'll have 5 or 6 done by the end of this year. So it's cool. So it's full on.
I know, and the thing is, again, I'm going to double back, but I do want to ask about the social media growth, because there's a lot of businesses here that are listening who would aspire to get their business to a very similar level. It's funny, we have very similar stories. It was what was Gary Vee's book? Crush It was the one I read back in.
You get me that.
That was the one that literally got me going, I should look at this social media thing. And I am going to double back on, the basics of financial equivalents when it comes to, I think of fitness, like food, movement, sleep, what the financial equivalents that people need to be aware of. But talk to us about the social media growth. That's something that when you think of financial planning, you think of money, you think of investing. Now, I geek out on it. I love it as a topic, but generally it's not something that connects with people. What is it? And I have my opinions. I think it's that jargon-free approach that you take that connects with the mainstream person. But what is it that you think about you and AskPaul in terms of the brand that grew on social media?
I'm trying to say this, I sound like a complete cocky prick, but it was probably that we were very relatable. I think people were so used to either guys in suits, guys with D4 accent, guys that they just had no connection with. And also, our industry makes it very complicated. Like, we make it extremely complicated for people to understand and for people to engage with us compared to any other industry in the world. So, when we started to break things down, I think people, number one, we built trust. I think that was the big thing we built. And we didn't ask for anything. It's all free. So we built a free financial academy. It took me years developing the financial academy with content. There's thousands of hours of content there for free. So, and then we were hoping that if we did that, people would say, you know what, I really would love to sit down with him or his team, or I'd really, have this old pension plan, or I'm trying to buy this house, or I want to sell my business. We'll book an appointment with him. And that's really what it was. So building the trust, jargon-free, building a bit of trust, and being constantly there as well. Now, I do get a few kids, I meet them, people approach me on a mail sometimes. You ever got on my TikTok page? Or melting me head. So we do overkill it sometimes. I get that. But you might as well be out there. You need to have a good presence, I think. But yeah, I think it's building the trust and trying to help people understand the basics of finance. And as an industry, we have, like, if you look at the budgets of Irish Life, Aviva, New Ireland, Royal London, the banks, like, they're making a balls of it. I mean, nobody trusts them. Practically nobody trusts them, in my opinion. No one understands what they do. No one understands the products when they take them out. And yeah, I don't understand why that is, because it's not that difficult. Like, if you look at a pension plan, I'm not trying to get into pensions too soon on this, but a pension plan, if you're on the higher of income tax, the government give you 66% return. And you got people talking about Bitcoin, you got people talking about stocks and shares. A 66% guaranteed return from the Irish government for the next 20 or 30 years on a compound interest is the only way to build, is the easiest way to build wealth in this country. And everyone should have one, but no, not everybody has them. So yeah, that's just a disservice, I think, to the public. If you were in America and you had that scheme, or in the UK, everybody if you look at the 401k in the States, everybody has one, everyone understands them, they understand who their stockbroker is, what stocks are in, the price they're paying, the taxes, the implications, because they get taught it in school. They know leaving what to do. We don't. So I suppose I genuinely am passionate about it, and I think, like you, if you're passionate about something and you dedicate enough time to it and you're trying to educate people and you're doing it on that kind of basis that it's free, but you're hoping people will trust you to do business with you in the future, that's honestly the win. Where I do see it, and we had first mover advantage, Brian, even like you. I mean, in fairness, in the Irish market, you're one of the first out there as well. There's loads of advisors online now, but they're doing it for the wrong. I'm not slagging them. They're doing it for the wrong. They're trying to get clients, and all their ads are so salesy, and they don't do the free content, and they're not consistent enough with their content. You can see them popping up online when they've clearly had a bad week or a bad quarter, and they're trying to get sales in, and you can kind of smell the desperation of them. So, and the public are cute as well. They know that. So, yeah, I think that's kind of our social media growth strategy. Be trustworthy, be consistent with your content, and yeah, try and speak to people like an arsehole.
Yeah, it's so true. It's such great advice, and there's genius in the simplicity, because that consistency is key. One of the things that I won't say irks me, but I do a lot more business consulting with people now, is that where you can smell the desperation, where every post is either a hard sell or there's nothing for weeks or months, and then it's just a video with the buy into my service. And I think whether that's financial advice, personal training, or any business, people can smell that a mile away, and it's something you need to avoid. And you do that by digging the well and not doing it when you need it. You provide that consistent content and providing that free value to people and get them to come to you. I think that's a very underutilized marketing tool for building any business. You mentioned there about the pensions. It's funny you say that, Paul, because when I set up my pension a few years ago, I was sitting down with my financial advisor at the time, and he was going through it with me, and I literally was like, what's the catch? I was like, that sounds way too good to be true.
Yeah.
What's the catch? Because you one of the things with Irish, and this is what I want to pick your brain on, is I have read probably 100 books on financial advice at this point, but they're nearly all geared towards the American market, stock market, index funds, things that aren't really applicable to Irish investors because of the tax and the things that are impacted by that. Talk to us about, and again, we won't harp all about pensions because obviously, but talk to us about that break from the government and where somebody that's living in Ireland who wants to invest in Ireland should go to improve their financial literacy. Obviously, following your content is going to be key, but where else should people go so that it's not just got this American skew in terms of investment?
Yeah, look, in fairness, the one of the big questions we get online, you can tell the demographic, they're usually early 20s. How do I get into the S&P 500? Because I listened to Tony Robbins for God how long? And everyone forgets
That was me. Same question I asked 10 years ago.
But everybody does realize Tony didn't make his money in the S&P 500. So it's very easy to pick, just be very careful with the American content. And as well as that, American content, just for those that don't know, the S&P 500 is the top listed or the biggest stocks in the S&P 500. And in typically American fashion, they only talk about the S&P 500 because that's what Americans do. There's a whole world. Now, 66% of the world equities are made up by the New York Stock Exchange. But yeah, you want way more diversification than just going after the top 500 companies in the New York Stock Exchange, in my opinion. But a lot of people get a content. There's not enough content creators in Ireland, number one. And there's not enough books. And there's not enough literature because we're such a small market. And again, if you look at what they do in America with the Robinhood accounts, Robinhood's practically free for people to trade, but they use their data and their trades to sell back to the company. So you're kind of like you're the client, like in Facebook. You are the product. And a lot of those people will lose money because even if you try to go for a passive play where you're picking an index or picking the S&P 500, if you have access to this money on a trading platform and you see Tesla stock over there, you're so tempted to say, I'm going to put 100 quid into Tesla because I know what I'm doing now. I know the new Tesla's going to go up. Then Tesla loses shit 3 weeks later. You don't know what to do and you panic and you sell it and you kind of lost money very easily. So they've got a massive problem, what's called a retail investor, not making money on those platforms because the behavior gets in the way. So very much like you when you're talking to your clients from a fitness point of view, it's what they do, behavior. Everyone knows to get fit, not being smart. I'm only trying again after 20,000 attempts and failing is eat well, don't eat shit, move more, maybe hit the gym a few times a week, but your own behavior gets in the way and your brain gets in the way. It's the same with money. So if I could hand my body to you and let you train my body every single day, I'd be ripped and I'd be a fucking great Nick because you know how to do it. It's the same with your money. Give it to someone and let them do it for you because you probably don't know how to do it. And it's not that easy. But sorry, back to Ireland. I'm going to say the AskPaul.ie page. There's a few books floating around the industry, how to be good at money. He has a good book out. He's from the RTE show. The problem with those type of books, in my opinion, not my own years, is that, in my opinion, rather than reading the book, you'd want to structure the book, and we're looking at the book at the moment, but you want to be structuring the book in around financial planning and what I should do. It's not going to tell you how to invest. It's going to give you the basics of an understanding. You still need to sit down with a financial planner, in my opinion, because it takes an hour out of your day, out of your life to sit down with a financial planner, and guaranteed the skills and the learnings that you get from that hour are going to be far more valuable than reading a generic book about everything you have. And like I said, we're doing we have a book out early next year, and I hope it'll add value from an overall financial planning context. But I'm going to say in the book that everyone that reads this book will need a financial plan, either with me or somebody else, I don't mind. But you're going to need to execute it with a professional because there's just too much information. And everyone's situation is different. And it's a bit more, I know we're going to put the parallels between our industry and yours, Brian. Fitness industry, unless you have medical complaints with a client, it's pretty much the same. I'm guessing, it is. It's
99% of people that have a goal for weight loss or build a muscle, assuming no underlying issue, the process is very similar, minus a few tweaks and changes.
Yeah, exactly. Yeah, and then but my industry is completely different because, you've got maybe one income or two incomes in the household. You got two different people, kind of different paths maybe from finance. You've also got different levels of income. You've got different tax breaks. You've got people that made bad credit decisions in the past. You might people that have had pensions, have no pensions. People might want to emigrate. There's a million and one things to find out from somebody in a financial planning consultation before you can give the plan. So it is a little bit different. So I think, honestly, and whether it's us or somebody else, please just get yourself a session with somebody that knows what they're talking about, rather than looking at all this American content. To be fair, it's just the easiest way through it. Like,
with the American content, and I have talked on this podcast before about that, because it's completely different. It's literally like a different language, because the things that apply in America don't apply in Ireland, and vice versa for a lot of cases. Hence, when I found out about the pension funds and the tax breaks, I actually was like, what? This can't be right.
How do I not know about this?
How do I not know about this? I'm like, why does everybody not know about this? Oh my goodness. It's one of those things. The same as when people are trying to lose body fat. I'm like, if you've never heard of a calorie deficit, I'm like, well, that's the number one thing you should fucking know about. Like, it's the thing that's...
But the industry's gone. I noticed everyone talking about, you've been talking about for ages, but I noticed now that everyone's talking about calorie deficit, but that wasn't the case 2 years ago.
No,
I don't think. When I looked at content from fitness, it was always talked about. Obviously, you bring yourself, but now nearly every piece of content I have, it's almost like it's a new buzzword. I know it's the obvious thing that's been in the industry for years. But nearly every single creator that's in the fitness industry is talking about calorie deficit all the time now. I don't know how that sparked. It's different, but same with us. With pensions, we have pension season in September, October now. So you're going to get pension ads thrown at you from everywhere, including us. But it's understanding why you need a pension and how the tax relief works. So if you want to bring people through that quick, it's very, very simple. As you said, Brian, sit down with an advisor. It's so easy. Basically, a pension is just a savings account that you don't touch till you're 60 in the majority of cases. If you have a company pension plan, so if you work for me here at AskPaul and you leave and you have a company pension plan, you can access that proportion from 50 years of age. So it's really cool. Not many people know that. So anyone that has an old company pension plan, make sure you understand where it is, how it's managed, and does it form part of your plan from 50 or 60. After that, you put money in like you do a normal current account, where it's a credit union or a bank. You put money in every month and you take it out. Every time you put money in, the revenue give you money back, or they top it up, whichever way you want to look at it. So if you put in €100 today and you're on the higher rate of income tax, so earning more than 40 grand a year, you're going to get 40% back from the revenue. So they're going to give you 40 quid back, which means you have 60. Now, if you reverse it and say, okay, well, I have €60 and the government are making up to €100 for me, that's a 66% similar return. That's guaranteed every single month right up to retirement age. So it's that simple. You just get massive checks off the revenue, either back or added into your pension plan, depending on the way you're structuring it. And then after that, you can decide to invest that money, but you don't have to. You can leave that money sitting in a deposit account if you want. If you're so risk averse, now you'd be mad to do that, because over a 10, 20, 30-year period, equity, stocks and shares will typically give much better returns than number one, banks, especially Irish banks, and number two, inflation. So that's what you're trying to beat. So make sure you value your money's there.
What about
savings account?
Just on that, Paul, because when I set up my pension fund, it was when I switched over and transitioned to an LLC. So I was able to set up an executive pension plan. So it's slightly different. How does it work for those that are self-employed? So for those that are listening that are self-employed,
so it's the exact same pension, except it's just called a personal pension or a PRSA. This is the other thing the industry have done. So you've got what's called an executive pension, which now needs to change to a master trust. Another bit of legislation. And then if you're self-employed or working for somebody that doesn't have a pension plan in work, you need a personal pension or a PRSA. So again, the industry, we should just have one contract. We should just have a PRSA that everybody's in. Either you're in it through work or you're in it through yourself. But the industry's just made it very, very complicated for people. But so either have a personal pension or a company pension. That's really it. There's a bit of negativity towards pensions. I hear this sometimes. My granddad had a pension and he lost everything. It's very, 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 very difficult to do that. So what people usually talk about, if you go back to, do you remember Waterford Crystal, a massive company, went bang, went bust. Years ago when people went into company pension plans, the idea was, back in the 80s and 90s, that you work for me for the next 40 years, you don't change your job, you stay here, and when you retire, we'll give you 2/3 of your final salary till the day you die. That was grand. People retired at 65 and they were dead by 75. And it was kind of straightforward enough. It was 10 years. But now people are living longer. And the cost of money is more expensive as well. So what happens to those schemes is sometimes those old schemes are called defined benefit schemes. Sometimes in the past, like Waterford Crystal, they would have ran out of money and had no money left, and they had to close that pension plan. So that was a promise from a company that was broken, where your pension is just your pension in the company. You put money in, and wherever you invest it, which is going to be typically diversified in loads of different funds, when you get to 65 or 60 or 55, whatever you want to get out, you have a big lump sum there and you take it out. It will fluctuate in value though, because you should be investing at your age in equity stocks and shares. They'll always go up and down. But over the long term, they typically have a really high return. So those old kind of, they're not saying they're not old wives' tales, it's kind of disingenuous to say that, but they're old stories of old pension plans. We've got way more regulation in the country, and any new company pension plan that's set up is not a DB. Nobody does new DBs anymore, practically nobody. And a lot of companies, a lot of people listen today. Like when I worked in Irish Life, I was in the DB plan, and then by the time I'd left, they closed down the DB plan to new employees, and they were all in what's called a defined contribution plan, where the company put in, you put in, it's your pot. When you get to retirement, whatever's in it's in it. There's no promise per se of X amount from retirement age. So just again, be careful where you're listening to, or who you're listening to when it comes to pension plans. Same with the property market. Property market's going to crash. That barstool advisor, your uncle, that got burnt back in 2007, telling you the property market's going to crash, you don't buy. The property market continues to increase along with mortgage interest rates, and you're then paying a higher mortgage next year, the year after, because your uncle hasn't got a clue what he's talking about.
What's your thoughts on diversification then? Because the reason I asked that, because I do have a follow-up question that I'm going to ask about crypto, because when I think of crypto, for me it falls into the category of too confusing, don't understand it, don't invest in it. So for me, it's not part of my diversification. I've got my pension fund, I've got real estate, I've got a few other things that I use. What are your thoughts on diversification in general then? Do you think because of the Irish market it should be primarily pension based and then anything else you want to add on, or what are your thoughts on it?
I think people are impatient. I think everyone wants to be rich tomorrow, and I think the pension plan doesn't suit the narrative. You can show somebody genuinely speaking, very easy for you at your age to have $1 million in your pension plan at 60. Like really, really, really easy with growth, 6 to 8%, tax relief from the revenue commissioners, and tax-free growth in the pension. It doesn't get taxed when it's grown, by the way, which is another part of it. So it's like growth on steroids. The pension's the easiest way to build money, easiest way to get there, but it takes decades till you can access it. Diversification, typically speaking, you'd want to have a pension plan, but also life is about balance as well, Brian. There's a certain element of don't have a pension plan if you're still living in your parents' box room. Stop your funding your pension and get your deposit together and get yourself a house ASAP. That's more important. And I know a little bit of money into the pension is okay, but sometimes I think people need to double down on certain financial aspects, and one of them is definitely getting on the property ladder, in my opinion, because you need to be mortgage free by the time you get to retirement age, 60, 65. Otherwise, when you get your pension's going to be paying for your house. You'll have no money left over if you still have a mortgage outstanding, or if you're renting, God forbid, if you're renting when you get to that age, it is genuinely going to be tough for people that are in a situation. So I think pension, investment account. So it's a very basic financial plan. There's 3 parts of a good financial plan: protect, grow, and replace what you have. So protect what you have, income protection, life specified illness cover if you can't get income protection. So income protection is a no-brainer. Grow your income, make sure that you have like an investment account in the background where your money's making money, so kind of money you don't need for 5 years. And then replace it with a pension when you get to retirement age. Make sure you have no short-term debt, or little or no short-term debt. And then the biggest one is an emergency fund in place, whether 1,000 or 10,000 euro when the credit union should shit go wrong. That's it. I know it sounds very easy, but that's literally all this is. It's not rocket science. But what people get confused in, you might have £1,000 a month, I might have 500 quid a month. Doesn't mean I shouldn't be doing what you're doing. Just means you're going to get there a bit quicker than I am. And that's okay. So everyone can do everything I spoke about can be done from 100 quid a week.
I have a partly selfish, partly selfless question, because this is very applicable to me, but I think it's relevant for people that are listening, because you mentioned the property ladder there. And if you're living in your parents' basement, the first thing you need to do is get out and get onto the property ladder. Something I've been curious about, because I have properties, but they're investment properties. And again, I'm not going to get into my details where I've got the cash flow from properties that exceeds the rent I'm paying and the way my own financial personal plan. But would you advise, and this is something I've heard, I'm looking into now potentially building a house closer to where I grew up, mortgage free, cash and different things if I can. one of the pushbacks I get when I mention that to people is a mortgage is going to be the cheapest money you'll ever get. Okay, talk to us about that, because there's a lot of people listening who are thinking about getting a mortgage.
Not now at all. So mortgage interest rate. So just I won't give too much of an economic lesson on this. I'm not boring people. So this time last January 2022, mortgage interest rate set by the European Central Bank. So obviously we're in Europe. Everyone knows that. The European Central Bank looks after the monetary system and policy for the whole of the Eurozone, including Ireland. Obviously not the UK anymore because they jumped ship. But everybody else we look at, the ECB looks after monetary policy. So our Central Bank of Ireland reports basically back into the European Central Bank, and we do what the European Central Bank says. In January, February, March last year, interest rates were zero with the European Central Bank. Free money. They get free money out to the banks, and the banks lend it to you and me. Typically speaking, this time last year, it was before, maybe 18 months ago, Irish banks, when the European Central Bank was zero, were charging an average of 2.8% above that zero. So your mortgage, typically speaking, was went from 2.2%, 2.1% up to about 4%, depending on variable rates, fixed rates, but on average about 2.8%. This needs to be considered. Just remember that 2.8% when interest rates were zero, okay? Since last year, in order to gain traction with inflation, so the European Central Bank's main objective here is to keep inflation at zero, as low as possible, at about 2%, 2.5% is the target. It was zero, and it was only zero because you were pumping the Eurozone with money called quantitative easing, trying to get us out of the financial crisis mess of 2007. That all came to an abrupt stop after COVID-19 and after the war or the invasion of Ukraine by Russia. This started what's called a massive energy crisis. An energy crisis really pushed inflation up. Inflation was already increased on the back of COVID-19, but the war or the invasion really pushed energy prices up and inflation up. So last year, the European Central Bank were looking at inflation across the Eurozone at 8%. Simply cannot happen. It's a shit show if it's 8%. The only way they can bring inflation down is to increase interest rates on mortgages. People think this is weird because then everything's going up against me here. So my cost of my car insurance, my bread, my milk is going up. Why are the bank putting rates up? The reason being is when they put the mortgage interest rates up, it sucks money out of the economy. You pay more to your mortgage. So you can't buy more stuff. You can't go on holidays. You won't change the car. So it takes money out of the system and then allows inflation to fall. Okay? That's why interest rates go up. Now the European Central Bank today is 4.25. So it's come from 0 to 4.25 in less than, well, just over a year actually, sorry, about 12 or 18, 12, 15 months, I think, 15 months. So it's gone from 0 to 4.2. Now, remember what Irish banks were charging when it was 0 was 2.8 on margin. 4.25 is what the European Central Bank is charging our banks, and eventually they're going to pass that on because they're Irish banks. When they pass it on, we have a massive mortgage crisis. And a genuine, I'm not trying to scare the shit out of people here, but we have people listening to this podcast today that will have a mortgage for 2.5%, 2.6% for the next 2 or 3 years. When they roll off, they're going to be getting letters saying 6%. So your mortgage at 1,500 quid, 1,600 quid be going to 2,100, and the cost of interest over a 30-year mortgage or 25-year mortgage might be going from 160, 100,000 interest costs and maybe 300 grand. So you're going to notice a massive change. And so I don't think the full extent of that increases has been felt yet, because practically everybody in around my age, your age, younger, that bought in the last 5 years is on a fixed rate. So they can't be touched because rates going up doesn't mean nothing to them. They're locked into a fixed rate. It's when these guys start coming out this year, next year, and 2025 is when we're going to notice the problems. Now the European Central Bank is that 5 or 6% is what the inflation rate is now. They're not going to get it to 2 next year or the year after, in my opinion. It's going to take a long time. And when they get it to 2, say they get it to 2.5 if they're lucky, Brian, they get 2.5%, they're going to be scared shitless of dropping interest rates on mortgages, because if it goes back up, they've done a bad job. So I don't think you're going to see interest rates as low as what they are today. I think they're going to fall much lower than 4.25 with the European Central Bank. So I think the next 2 to 3 years we're going to have to settle with rates instead of being 2%, being 6%, which makes a ridiculous difference to your financial circumstances over your lifetime. And there are things that happen that people don't know about and they don't understand. But yet you might have somebody trying to switch their ESB bill to say 50 quid thinking they're doing well. In the background, some lad in the European Central Bank has just brought your mortgage from 1,600 quid to 2,200 quid, and you don't even know about it yet. You won't know about it until you come off your fixed rate. So And that's what AskPaul was developed for. It's not, it makes no difference to me what rate you're on if you stay with your existing bank and come off. But there's no point in booking a consultation with me showing your pension and your investment account and pretending everything's rosy. So that's why, remember I said earlier on, it's so complex to what people have before you offer them the plan. So a plan's going to be different. I've never ever seen two financial plans the same. We have similar recommendations, but two people are never the same. So look, I hope I'm not scaring people, but you know, it's going to be a massive problem in this country in the coming years with interest rates.
Awareness is key. You said something there, Paul, that was very profound that I've used in terms of fitness examples, is when people are like, okay, what's the supplement I should take? When I'm like, well, you haven't even looked at your food, your exercise, your sleep.
100%.
And you said there about my ESB saving 50 quid when you've got this in the background. And I think for people and bringing that awareness, it's key. It's weird. I can't remember the quote, but it's, you know, history doesn't repeat itself, but it rhymes. I think it's Warren Buffett or Charlie Munger. And
it's cyclical. It's all cyclical.
There's very shades of the 2007, 2008 and the variable mortgage rates coming back to the forefront. And I think just having people aware of that, the misconceptions of nearly the old wives' tales or the old advice of, you know, your mortgage is going to be the cheapest loan you ever get. Question that. That's what your financial advisor's for and your content's for.
And like, in fairness, but if you're going to build a house with cash, obviously that's a phenomenal thing to do. A lot of people say put debt on it. Just put 100 grand to keep 100 grand in the bank. You won't get that for less than 5% next year if you go to buy next year. And if you've got 100 grand in Bank of Ireland, they're going to give you 1% a year if you're lucky. But they're going to charge you 5 to put a mortgage on your house. So you're borrowing your own money. It's like, so there's no point in having, you're literally going in. Like, people think the bank take your 100 grand, your 50 grand, your 10 grand, they put in a nice little safe deposit box at the back of the bank with your name on it. They don't. They fucking lend it out as soon as they get it. So your 100 grand is not sitting in the bank. Your 100 grand's in, whoever's listening to this has debt from, say you Bank of Ireland, you put 100 grand in deposit. It's not sitting there waiting for you. They've lent that out before it even hits the bank. That's gone on a credit card, a mortgage, a car loan, a personal loan to somebody else, or else they've gone and invested it. They keep very little money in cash banks. And this is why, I get too much into American content again, this is why in America they have a bigger problem in all the regional banks. Because all the regional banks, people got scared of them from the Silicon Valley Bank going. People got scared, started looking for the money bank. The bank hasn't got the money. They don't hold your money.
Yeah, that's the runs on the bank.
That's what a run on the bank is. They go to the bank, get me money out. They don't have your money. Your money's lent out by the bank. So I think a lot of people don't understand that even very basics of what a bank does. That's what I always say, invest your money. Don't leave it sitting there. You know, I know it's easy. Of course, you'd say that you're an advisor, you want people to invest. No, I know the banks invest in your money. Why are you not fucking investing yourself? Why are you giving it to a banker to invest? Like Bank of Ireland, AIB and PTSB are going to make billions this year in profits on the European Central Bank. They're taking that. So the rate I said of 4.25 for lending. It's nearly as high for deposits. So all deposits we have, if you put, if all us pull money together that's on this podcast today, see everyone puts in 100 grand. Just say I say we get to $1 million. We'll give $1 million into Bank of Ireland tomorrow. Bank of Ireland give us less than 1% on that. Bank of Ireland take our $1 million, give it to the European Central Bank, and the European Central Bank gives them 3.5%.
Yeah.
The fuck? What? That doesn't make sense. You go and put your money somewhere that's going to get you 3.5%. Just because you have a branch down the road has a nice sign on it and a few funky ads on TV, it's just nonsense. It really is nonsense.
We never question it. I think that's why it's so important that you're putting out the content, and I think why it connects, because we don't question the money. Money is one of those topics that people are afraid sometimes to speak about.
Subject, isn't it?
It really is. Like, I think money, sex are the kind of the two that, depending on who you speak to, are like, oh,
we're going to talk about money on this podcast.
Yeah, that's fair. Well, there goes the next question I was going to ask. All right, we'll bring it back. I want to touch on crypto, because there's no way I can record a podcast with the financial advisor, someone who's putting out as much great content as you, Paul, and not talk about crypto. As I mentioned, for me, it falls into the category of too difficult. And I've read probably 7 books on crypto, all the way from mastering Bitcoin to investing in crypto 101. And I still can't, it doesn't make sense to me. I can't figure it out. All I can get is that it's nearly my lottery fund. If I wanted to put money in it, if I'm happy for it to go to zero, I could put a little bit into it. What are your thoughts on it? Because I'm going to throw crypto into the title somewhere, because 100% it'll get an extra couple of thousand listens just because of that. But talk 100%. To us about crypto, in particularly for Irish investors, and if there's any difference, because I'm not sure, again, outside my wheelhouse here, whether it's different in the US to Ireland, etc. I know there's Coinbase and places to invest, but talk to us about crypto.
So I think I started by disclose that I have crypto. I think I put about 19 grand in last year. I think it's worth 28, 30 now or something. I put it in for 10 years minimum. And I'm going to be very honest, I put it in for fear of missing out. Still don't understand it wholeheartedly. Now, I do understand blockchain, and I know why blockchain exists, and I think blockchain is going to be here in the future. I think we're all going to be operating on blockchain eventually. But blockchain wasn't set up to be the currency that it is. But like anything, if there's a price on it, it's like art. You know, if I look at an art tomorrow, I might look at it and say, yeah, that's cool. That looks great. I'll buy it. How much? It's $1,000. Yeah, great. I'll buy it. It's 200 grand. Not a fucking hope. Not paying 200 grand for that. It looks like a kid drew it. It's almost the same when it comes to cryptocurrency in that it moves the same way as a pyramid scheme. Now, it's not a pyramid scheme, but when you get so many people trying to get into something, trying to buy something at the same time that has a limited supply, you're going to drive the price up. It doesn't make a difference whether it's this pen, this phone, or whether it's cryptocurrency. And that's all that cryptocurrency is. It's just a blockchain. And what you're doing when you buy into it, like I bought into it last year because of 19 grand. I think it dipped to 12 grand at one stage, to be fair. Didn't care. And it's back up to 30 grand. Haven't touched it. I think got to 34 or something. I can't even get into the Coinbase account because that's the last. It's not
Probably
even
better off that you can and just let it roll.
Yeah. But again, I put it in more for kind of content-wise to say, I'm going to do this. This is what I'm doing, why I'm doing it, and leave it in the future. I never got involved. I actually set up till 4 o'clock in the morning for Gary V's for his NFT coins and had a substantial amount of cash going. This is going to take off. Don't understand why, but I know everybody's going to get behind it and it's going to drive the price up. I didn't because I was actually at 4 o'clock in the morning going, fuck, I really don't understand this shit and I don't believe in it. Whatever about Coinbase being or blockchain being the background, being
that's NFT, that's non-fungible tokens for Gary V's.
Non-fungible tokens. It's just art on a crypto on the blockchain, mental stuff like worse than art, like as in just massive values. And then they were promoted by various different YouTubers and different people. But when that happens, Brian, unfortunately, like if I got enough big YouTubers from America to say that I've designed this new pen, it's a big pen, I'm going to wrap it with, AskPaul, and I'm only 100, and they want one, that pen will go up in fucking value. It will go up in value. People will want it for a certain period of time. And after 6 months to a year, people are going to go, it's just a fucking pen, then. I'll sell it to somebody else. Then somebody else doesn't want it because there's no demand for it. So blockchain or any cryptocurrency is basically pent-up demand trying to buy something that's in short supply at that any given time. I genuinely believe if you go back to the YouTube guys because they've got such a pull. Like you look at the Prime stuff. I mean, fuck me, you couldn't write that. Like that's almost like Simpson stuff. Like you couldn't write how that product was going to go 10 years ago. No one would believe you that two guys would be able to do that with something. They can do it with anything these days. So if you got enough YouTubers to say this coin is just being released, it's going to go, we've been told, we've got inside info, whatever the fuck they're going to tell you, people will buy it. And when it's in short supply, it drives the price up. And believe it or not, the more the price goes up, human psychology is they fucking want it more. Mm-hmm. And that's all that happens here. So I'm in crypto for the basis of probably, like I said, maybe fear of missing out in the beginning. I understand blockchain. I think it's going to be here into the future. And I think my 19 grand is safe enough. I don't think it's going to fall much lower than what it did, but in 10 years' time. And that's really it. It's got like less than 0.1% of my cash. Like it's not being a dickhead saying that, but I sound like an absolute sap saying that. But it's so small in my portfolio. I'm not being
in the grand scheme.
In the grand scheme of things, yeah, without being too arrogant. But I mean, it's there. It'll work away in the background, go up and down in value like a yo-yo. And it's more for that experience of seeing what's happened with it. Because again, like you might play with some certain kind of, whether it's a new exercise or a machine.
Keto. I always think a keto,
Exactly. Yeah, you know what? 100% actually. That's such a good example. You kind of have to try it for your clients as well, and you have to be in it to understand it and watch it. It's okay somebody saying cryptocurrency is going up and down, but when you see your own cash going up and down, you really feel the effects of it, I suppose. But I wouldn't be back in crypto to say it's 100% going to be where I'm going to make my wealth. And the guys that got in early, at $1, 2 cents and all this malarkey, fair play to them. I mean, they seen something coming and they risked it and they took massive risk and they got massive rewards from it. But that was blockchain. It wasn't Dogecoin, or it wasn't fucking Ether. It wasn't any of these other things. It was the blockchain that they got in on, and Bitcoin was the first coin on blockchain. So somebody saying today, I'm going to create a coin and it's going to take off like Bitcoin, it's not, because it's taken off like blockchain. Blockchain is the fundamental thing behind all this that will stay. All these coins will come and go, other than other than Bitcoin, in my opinion, is the most stable one. But yeah, that's my tuppence worth. I'll wait for loads of abuse from crypto warriors online later on. But that's all it is.
Well, the first to market, one of the things I think is really important when it comes to building wealth, whether that's in real estate or crypto or anything else, is there's always going to be a survivorship bias depending on where you hear your information from. And I think crypto falls into that. I always think of crypto very similar to the kind of tulip mania in Holland.
I was going to say that as an example later on.
Very,
tulip in Amsterdam,
which is crazy. It's only worth what people think it's worth, and you buy into it. It's art, and that's okay, and that's a cool. And as long as people know that coming in, I think that's probably. And again, not my 2 cents. I can offer about keto and nutrition, and I'm happy to give advice on that. But from my own personal experience, I think that works really well.
The other thing as well here to remember, if it sounds so good to be true, genuinely is. And those people in the very early stages of blockchain have made a phenomenal amount of cash, but I remember people making a phenomenal amount of cash back in 2007 out of property. And then when the property bubble did go, they took the money, those that got out early enough, do you know what they did? They took the fucking money out of property to put it into Irish banks because they couldn't fail. And then lo and behold, a year later, they were gone either. When you chase that run, there's very, very few people, there's loads of them out there, but very, very few compared to the amount of people that, if you look at the people that invested in cryptocurrency over the last 10 years, I'd say, I'm going to say less than 0.5%, less than 0.2% even, have phenomenal wealth from that still, because they invariably have taken it and put it somewhere else for the risk and the reward, because that's their personality. That's what they do. They chase it. And when you're chasing it that much, something's going to fall at some stage, because you're chasing high risk strategies.
Final question then, Paul, on that. Something that I've completely changed my mind about in the last 10 years. I've been very fortunate in the last 10 years with the business, the books, everything that I get to do. And I'm one of those very fortunately well-off people. But something I changed my mind about was partly down to, reading all the American books and realizing this isn't applicable. And then I'd follow your content and talk to financial advisors and go, well, this isn't applicable to me. So I went from what you mentioned there, the person that was chasing, and I was trying to put money into things, and I was buying single stocks with Davy Select and all of these things. And then at a point in probably my early 30s, I was like, fuck this. I was like, I just need to go put it somewhere where it's just going to be passive. And I just invest into my pension fund, or I put it into a property, or I put it somewhere that it's just going to grow itself as opposed to chasing. If you were to put, and this is a little bit of a loaded question and it's difficult because I know it's individual to each individual person, but if you were to put a percentage on how much of your money you should be putting into things that are effectively looking after themselves, like a pension or, a property, or, even your own property that you live in, versus the chasing, the stocks, the crypto, how would you split it?
The only chasing I've done is the crypto, and I haven't even chased that. I just had that fear of missing out, so I'm not chasing a return there. Don't have anything else. Everything else is in managed funds, in equities, a bit of passive play in equities and property, and the pension. So you shouldn't be chasing that. Genuinely, if I fluctuate in weight all the time, I eat shite, I go to the gym for 2 or 3 weeks, I stop. I'm the typical fucking bloke, I probably suppose, businessman, wife, 4 kids, fucking mental, and I eat like a teenager. I just ridiculous amount of shite. Okay, be honest. If I could literally say to you, Brian, there's my body, go do the workout, do the eat and do everything, and I could sit at home, my arse doing nothing, and you do it all, I'd be ripped within 4 weeks. You'd have me sorted within 4 weeks if you had full control of my body. I know you would. No, I need your brain as well, and I need your drive, and I need everything, all your knowledge and experience. I need that to get ripped. Same with your money. There's no point in trying to chase it. I get this people all the time, like, maybe now with pubs even, or after COVID-19, and people saying, oh, I have this app on Revolut, I'm at the buying this stock or that stock. And you're saying, why? Oh, because I knew Tesla was going to go up, and I knew fucking Netflix was going to go up, because everyone has Netflix. Fast forward 12 months later, Netflix is on its knees after losing millions, billions, and stock flies through the floor. What you do with Netflix? Yeah, took it out, went last week. Like, do you need the money? No, why take it out? Because they lose a lot. Losses, bollocks. It didn't. The stock decreased. It's always going to go up and down in value. Why don't you just hold it for another year or two or see what Netflix do? So is the behavioural thing that people get into stocks thinking they know everything, get out at the wrong time? Because it's lack of knowledge. And, you know, I'm CFP qualified. Being a certified financial planner involves being very proficient in stocks, pensions, legislation around same, cash flow planning, inheritance tax issues, you name it. But even at that, I still don't manage my own money. I let a managed fund manage my own money. I put it in, leave it there. And yeah, I know if I went, I could probably maybe outbeat them 1 or 2 years out of 10 and make myself feel like I'm an investor and I know my shit. But don't. There's a guy down in Zurich that's managing 2.2 billion of money. And he's managing my money. And I don't care. I know I pay him a management fee, but I don't care. I go to bed every night sleeping. 32-year track record. Won the funds on 10% on average per annum. It's a phenomenal fund. And I'm good with that. Will the guy down the road probably get 13? Yeah, he will. But I don't need 13. So I'm happy where I am. So sometimes you just have to make a decision about what suits you, your financial plan, your financial life. Make it, and like you always say, stop comparing yourself to other people in the gym. You know, look after your own patch, look after what you're doing. And there'll be always another investment manager making more money. You're never going to have the best investment manager in the world. You're never going to have the best charging structure in the world, the best tax structure in the world. Like people say to me, we have this thing called the AskPaul Investment Club where I pick a managed funds, a few thousand people in it. I put in $2,000 a month, people put in like 100 quid a month, the minimum, right up to guys putting millions into this, selling companies and various different things. And it's great. But, you know, I get a bit of abuse online. And people should send me, I never look at the online stuff. In fairness, I don't get that much of a hard time. TikTok's a bit of a nastier place than
Instagram. That's the nature of TikTok versus the content, though, yeah.
Well, then they say, yeah, man's funds, bro, you fucking 41% exit tax. I go back, you get a pension. No, I wouldn't touch them. Okay, so you're getting 40% tax relief, tax-free growth, and you fuck off. Like, just go away. Just smash your phone and get offline. Like, don't be so ridiculous. But the point is, if you want tax-free growth and you want low management charging structures, the pension plan is the obvious place to go because it's longer term. Shorter term, the government, and you can get CGT portfolios as well. They're very, very hard to design. Are very hard to get to this exposure, I think, as some of the managed funds. But look, it's a case-by-case basis, and every individual is different when it comes to finances. Get yourself a financial planner, sit down with a financial plan, and find out where you are today. And be honest. I know you had Jerry Hussey on this podcast, so I'm in Jerry's executive coach over the last number of years. Jerry has this thing about the 3 A's. You probably heard these before. So it's accepting where you are and then taking a big action as a third where you're trying to action where you're going to actually be in the future. So a financial plan is very much that. You look at where you are today and you just accept where you are today and you acknowledge it and say, it's okay, I know where I am, made bad mistakes, made good mistakes in the past, and I want to drive into the future and I'm going to take the following action or the following steps to be able to do that. And that's all it is. It's not rocket science. And an hour with a financial planner will genuinely have everyone listening to this podcast sorted, whether it's me or somebody else. I'm not being smart. Goes down with somebody. But make sure they're a certified financial planner. If you want the product, we have a big product team here that people just want the income protection, just want the mortgage, just want mortgage protection, and they come back later for their financial plan. But certified financial planners do bring a lot to the table in relation to understanding where you are and trying picking a financial planner. For me, I think you want to pick somebody that has life experience and business experience. And I'm going to ditch all the guys here that work in the banks and life company. No disrespect to them at all. They're good guys, but they're working for a life company that can sell one product. And they're kind of protected by the life company. Where if you're a business owner, I think one thing we offer is that I'm a business owner. I've grown a successful business. I've sold it. I've had 1 staff to 68 staff. I understand cash flow. I understand personal life. I understand trying to make sure your personal life is run at the same time as your company life. Like you being busy and being in great shape. You know, one thing you get from you is that you're dedicated to what you do, but you're busy as fuck with all your other things. You have a million things going on. But you still make time for what you believe in. So I think that's very important as well when it comes to picking somebody to trust and deal with.
Yeah, 100%. And as I said, Paul, I've been following the content for so long. I think there's like, this is one I'm going to go back and listen to, because there was just nuggets of gold as we went through. But for those who want to reach out, social media, as you mentioned, obviously Instagram, TikTok, you're everywhere in terms of platforms. But is there anywhere in particular, obviously the website I'll link up for people as well, but is there anywhere in particular you want to send people off the back of this podcast that they can either go take action by following you or reaching out?
Yeah, I
anywhere?
think follow us on AskPaul if you haven't yet, especially on the Instagram page. And sorry, we do a lot on TikTok as well, but TikTok's so short form, so quicker, where you get a lot more longer form, interesting content. Again, if anyone does have any questions, you can ask them through DMs. They're always free. Or else, if you have a kind of a complicated case, send us to questions@askpaul.ie. We're always happy to throw our eyes over things. We have tax consultants that we deal with as well that will give a look at stuff for free as well. It's not too complex to have an opinion. If you want kind of real in-depth, proper advice, it's a paid-for service. But we're always interested in trying to help people solve problems and help them and point them in the right direction. So either Instagram DM or questions@askpaul.ie. And you put the Brian Keane podcast in the subject bar. We'll try and prioritise them in the day they come in, because we get hundreds of them a day.
Deadly. I love that. Paul, thank you so much again for the chat. Keep doing what you're doing, and we'll definitely at some point have another chat when the book is out, so I'm looking forward to that.
Oh yeah, do that, yeah.
100%.
Mate, thanks. Very good.
Thanks so much again.
Pleasure. Thanks for having me on. It's been a great one. Thanks.